Ryan Reynolds here from Mint Mobile. I don't know if you knew this, but anyone can get the same premium wireless for $15 a month plan that I've been enjoying. It's not just for celebrities. So do like I did and have one of your assistants switch you to Mint Mobile today. I'm told it's super easy to do at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Welcome once again to another hour of radio, another 36 minutes of podcast. Well, I have to think of the podcast list.
Actual 4 minutes of content. That's good.
Right. Well, three and a half.
Okay. Kelly's
roughly
granting you an extra 30 seconds, so you get 4 this hour.
Oh, 4 minutes. Thank you, Kelly.
Power
That's
that
so
she
nice.
has, yes.
And we are here, as we are on a regular basis, to help you through that apparently sticky, gooey mess that's investing. You kind of get up to it in your knees, and you're going, I don't know how to get out. You get involved with stockbrokers and insurance agents and all these people who are doing all these things to mislead you and really baffle you with BS. And we're going to eliminate the BS part of that. We might baffle you a little, but not with BS. 855-935-TALK is our number. 855-935-8255.
And no other national anthems from another nation in the Americas this time?
No, that was
okay.
Strictly last hour or
right.
last podcast.
So
Not doing it this
Canada.
time. No, we're sticking
Right.
We're sticking with the good old U.S. of A.
Which I find amazing about the U.S. of A. When I read stories like this, I don't know how to take it. Fidelity did a study of baby boomers, us old people. Hanging
old
on.
people, yes.
And 75% of you said, no, I don't have a plan for retirement. Which
that sounds pretty typically American.
Hey,
it's all going to be okay.
Right, yeah,
it's all going to be okay.
Well,
I'm sure of it.
People said
yes,
things like,
Mr. Tom, don't tell me I'm stupid.
I never thought of having to prepare a plan. Somebody else said I didn't know where to begin. And a lot of people also feel like I'm so far behind, it's just forget it, it'll work out. But, okay, I understand all those choices, but here's the one I find fascinating. 3 out of 4 people said I don't have a plan. All right, got that?
75% say no plan for retirement.
And then they ask them how they feel, how confident they feel about their financial health. 62%.
So I have no plan.
I don't know.
But wait,
I know.
I get it. Wait, hold on. I get it now. I don't need no stinking plan.
Okay, maybe you're right.
Everything will work out because I'm a good person.
Yeah, it will.
And it will just. I have faith in the fact that my stupidity will not impair my ability to enjoy a comfortable retirement on $14,000 a year from Social Security.
And so I was just getting to that because it still is 9 of 10 people. 9 of 10 take Social Security before full retirement age. 9 of 10.
$12,000 a year from retirement.
Which sounds great when you're 65 and you need the money, but then remember that's the same benefit basically you're going to get for the next, for sake of argument, 25 years.
Or until you die, whichever comes first.
And then there's people, but I'm going to drop dead by 75. Okay, if you know that. But very few people do, by the way, and most live longer than they think.
Yeah, I read an interesting statistic that said a typical American couple, husband, wife, that live to be 65 years old. Mm-hmm. The two of them live to be 65. One of them will live to be 95 or older. If they make it that far. Wow. Does that drive home the point that you're going to need 30 years of money, of income? And then I read another study. I talked about it in the podcast last week, where most of the baby boomers, I think it was half of baby boomers had nothing saved for retirement. Nothing.
Well, and it's a large number of people that couldn't afford a $400 unexpected expense. I get that.
And if you have nothing saved for retirement and you're a baby boomer, that means you're at your youngest, you're 58.
No, I think down to 55.
No, because it ends in
or
1960, I thought. Wasn't it 60 or maybe it's 64? Maybe it's 64.
I
So
think it's
55.
64, yeah.
All right, so let's say you're one of the baby boomers, and you have nothing saved.
Mm-hmm.
You are going to have to save pretty much all of your income
for the next
to have to have what they say is the average spending of Americans today, American baby boomers, American retirees. It's $55,000 a year that they spend on average. So you get 14 or 15 or 16 from
Whatever
Social Security.
Right,
yeah. Then you've got to get 30 from your investment portfolio. You run those numbers, you're going to find that if you don't have about $600,000 minimum, you are not going to be average. You are going to be subpar. You are going to be as above average as you think you are. You're going to be living a below average life.
Yeah, for a long time. That's the other part. People forget that retirement can last decades. You just pointed out. You could be your mid-90s. So
plus years. So the moral of this story is?
Well, I think the moral of the story is you got to be willing at any point in your life to sit down and say, here's where I am. Here's where I'd like to go. How do I get from point A to point B? It may be painful and you may have to make changes, but you should do it whether you're a baby boomer or younger. That's my take.
Oh, actually, it's better if you're a baby boomer and you haven't done it yet. You're a little late. If you're younger, you're smarter to do it right now. 855-935-TALK.
And Don are talking real money.
It may not be the sexiest website in the world, but it's your one-stop shop for real money information. TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
This is serious stuff we're talking about. Hey, it's your life. I'm Don McDonald. Over there is Tom Cock. This is Talking Real Money every Saturday live from noon to 2 on the West Coast. And if you listen to the podcast, you can call us on Saturdays from noon to 2 Pacific Time or 3 to 5 Eastern Time. You can also call 855-935-TALK anytime and ask questions that we'll put on the podcast that we do on an almost daily basis unless I take a day off. So give us a call, 855-935-TALK. And if you call during the live show on Saturdays, you also get a free copy of my book, Financial Physics, signed, sealed, delivered.
The second edition. Second edition.
Second edition.
Yeah.
855-935-8255. We are here to help. Give us a call, 855-935-TALK, and Susan is next. Susan, welcome to Talking Real Money.
Hi, Susan.
Hi.
What's
Hello?
up? Hello, we're here.
Okay. I have a question about an inherited IRA that I inherited from my cousin about a year and a half ago, and it is still being managed by management Raymond James. I'll just tell you.
Okay.
And it was probably around 70,000. It's now down to 65. I pulled it out of the mutual funds and just had them put it in an account because I thought, I'll just roll it over somewhere. Well, there's nobody to roll it over to. But I did look online and saw that Vanguard will, I think, work with inherited IRAs. But one, I don't know how to do that. I don't know how to get it to them. And two, I'm hoping they can just do something like a long-term CD. I thought maybe you guys had some better ideas.
A long-term what?
CD. Like,
CD.
just...
Okay.
Okay.
CD.
Yeah, okay, go ahead, Tom, because I'm a little confused about a couple of things.
Yeah, well, first of all, don't ever play the market. How old are you, Susan?
She said 65?
I'm 65.
Oh, I didn't hear that part. My apologies. So...
No, I didn't say it.
Okay, so, to go back. First of all, any custodian, Charles Schwab, Fidelity, Vanguard, Raymond James, they'll all do an inherited IRA.
Yeah, everybody.
Everybody does inherited IRAs. That's just a type of investment account. Like an individual retirement account, an IRA is something that you set up for yourself. You then put the money away for retirement. An inherited IRA is money that somebody else put away, and then they passed away and they left the money for you. It's a difference, but not a big one. But what you're really asking here, and you could call, by the way, you could go online with Vanguard, Vanguard.com, and set up the inherited IRA account very, very easily. That would not be a difficult thing to do. And then Vanguard would help you move the money from your current custodian. You said it was Raymond James, over to Vanguard. Now, here's where the tricky part comes in, because when you start saying a long-term CD, first of all, I don't know Don, how long is term?
The longest term CD typically is about 5 years.
Yeah. So,
right.
And remember, every year you need to be taking something out of the inherited IRA, a calculation that, by the way, the custodian will make for you. They will tell you here's how much has to come out, and you have to pay tax on that. I would not be using a CD for an inherited IRA account. Why not? Because the percentage you're going to make is going to be very, very small. I mean, I don't know, what is a 5-year even paying today, Don? Maybe 2.5%, 3%, something like that. So, and when you say playing the market, no, we wouldn't recommend that. But we would recommend, if you went to Vanguard, you could do the two-fund approach that we give out right here on the show, the Vanguard Total World Stock Index, and then some in the Vanguard Total Bond. That lends itself a little complexity. Go ahead, Don.
I just want to, though, ask, what is it about having your money in something other than CDs that concerns you?
Well, I guess what concerns me is within 6 months, it had dropped about $5,000, and I don't have enough savvy to feel like I can keep track of where it's been placed in these different funds to know whether or not that was a smart decision. So
part of the reason, I think, Susan, I believe that part of the reason is the fact that this has been at a brokerage firm like Raymond James, and brokerage firms like to perpetuate the myth that somebody must be, as you said, savvy enough to manage their portfolio. There is no need to be savvy, to be smart, to have any talent or skill, or to actually know what you're getting into. Because what we advise is not picking stocks or buying the right mutual fund at the right time. What we advise is that you buy the entire global market and combine that with a portfolio of bonds, but based on your tolerance for volatility, not your confusion, because the brokerage industry has a vested interest in making this process seem confusing, and they're doing the entire country a grave disservice in that. The only people the only people that this confusion benefits are the people in the brokerage industry, and they know it. They know it.
And so, going back to your situation, because another worry I have when you say I lost $5,000, we have no idea how that was invested, whether it was individual stocks or one, you said a fund of some kind. Maybe it was all in a stock mutual fund and it lost. The fourth quarter was a bad one last year. Should have come way back up, by the way, this year, because the stock markets are up. So maybe one place to go, Don, also would be to take the risk quiz to kind of get an idea about who you are around money. That's free. It's available at talkingrealmoney.com. You could take the risk quiz and then open the account at Vanguard and maybe even get a little help as to how to invest that at Vanguard.
And wait a minute, she's also getting a free book that will explain why investing isn't what you believe it to be. And you are not alone, by the way, Susan.
No.
We get calls like this all the time. Well, I just don't have the skills to manage a portfolio.
Yeah.
And your broker is going to be grinning in the background going,
that's right.
They bought the story. They bought it. They think it's too complicated for them, not knowing that their broker is probably just some guy who used to be a used car salesman and is now with a brokerage firm. No offense to used car salesmen. Used to kind of
Susan, you've got some work ahead of you, but I think you can do it. And I would again,
easy work.
It's easy work, and I would not recommend putting that in a CD. I don't think you're just not going to get enough growth over time that will make you the money you need.
As a matter of fact, you're probably going to end up making just a teeny tiny fraction of a percent above whatever inflation is. So it's almost like guaranteeing not to make money. And the whole point of investing money is to make money. And, as an aside, you can probably just buy long-term CDs through Raymond James. They sell long-term CDs.
Yeah.
They'll probably try to convince you to do something that's more lucrative for them, though, which is a very good that alone is a great reason to get away from a commission brokerage house like Raymond James.
Yeah, that would be the other thing to pay attention to, that you want 100% always fiduciary advice. You're not getting that at Raymond James. Another thing to think about.
No. They may say so, but they're lying. What you have to do is get them to sign something. I am always required to act in your best interest. Have them sign that. Very few will.
Tom and Don are talking real money.
Just about everything you need to know about money can be found at our website, talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Here's the reality of money and investing. It is far easier than the vast majority of people in the financial services industry would like you to believe. Money management is too easy to be this complicated, and investing is actually really easy. The only hard part is the emotions. And it's the emotions that you've heard on the show already today. It's the emotions that are getting people.
We had somebody that got out of their grandkids 529 because the market did something.
It felt bad.
Well, and Susan,
bad.
I lost $5,000. I got to do something. Not if it's properly positioned. You shouldn't be doing something.
Well, but people will still feel that. That's one of the reasons why they need fiduciary advisors, is to keep those emotions in check. If there's one thing that makes a 100% fiduciary advisor worth working with, that is the fact that they are required to keep you calm. That's their job, to keep you from doing dumb things. 855-935-TALK is our phone number, and Charles is up next. Hi,
Are you there?
We are here.
Yes, we are.
Well, good afternoon, gentlemen. I just have a quick question that I am not an investor. I'm on Social Security. I am doing very well.
Good.
Because I learned to live when I was younger, not spend that money. So anyway, my question is, with the problems that Boeing is having right now and their stocks being down to something like $3 and something a share, is this a good time to buy?
Well, now, wait a minute. I don't think Boeing is down to $3 and something, unless I missed something on Friday.
You didn't.
I think it's 300 and something. Actually, we'd have to go get the price, but
$381 a share.
Yeah, so it's not quite taking the tumble. But I think that raises an interesting point, though. Should you be buying stocks after they go down? The answer to that is, yeah, if you're buying individual stocks, but no, because we don't recommend owning individual stocks. It's simply too risky.
And let me just tell you another. Well, yeah, buying individual stocks is scary. And let me just tell you something. You may think Boeing is a big bargain right now at $380, but it was at $365 just 2 months ago.
Before the crash.
But yeah, so it went.
That's not
from
really
300.
That's not really.
It went from 365 to 440, and then they had the trouble with the 737 Maxes, and it fell off a cliff. But bear in mind that it had been maybe at ridiculously high levels before. Maybe that was unfairly high. It could be that this is not as low as it goes. We know none of these things, which is why investing in individual stocks, no matter how good the price appears at any given time, is way, 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 way too dangerous. No individual should be in individual stocks. It's just, unless you're a billionaire. So Bill and Jeff, if you're listening, you guys go ahead and buy individual stocks.
They
okay, well, mainly it's kind of Microsoft and Amazon.
Yeah, those are individual stocks, though.
But if you're not living on Mercer Island in the billionaire district,
okay,
then you probably shouldn't own individual stocks.
By the way, it's a pig in a poke. We do not know what might happen.
Do not buy pork belly futures. No pigs and pokes.
We don't know. Individual. I'll give you a great story before we go to the break. I mean, I love this about the video industry. Videotape was. I happen to know this because it was invented the same year I was born, 1958. 1985, the first
videotape was invented in 1958.
It was. The first Blockbuster video store opened in 1985. By 1989, there were 1,000 Blockbuster stores. You know how many there were 20 years later? One. It shows you how hard it looks.
Isn't
so
that in
simple.
Portland or somewhere?
But it shows you. I mean, ideas come along, they work for a while, they go away. Individual stocks are nothing more than that. They're ideas. Somebody said this is what the future is going to look like, and sometimes it's Amazon, and sometimes it's Blockbuster.
Well,
you just don't know the difference.
Look at retail. When I was younger, in my early working years, the number one retail in America, Sears, Roebuck and Company.
Yep.
Almost bankrupt now.
Yep.
Walmart, number one retailer. Who could Amazon may usurp them?
Who knows?
The world. That's why you own them all, because you own them for those times when they make a lot of money, make you a lot of money. 855-935-TALK is our number.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at talkingrealmoney.com.
Reality radio for a really great future. We're talking real money.
It's your life, and this is the stuff that fuels it. We want to help you save it, invest it, even spend it more wisely, and pay less in the process of doing all of those things, and avoid getting ripped off. There's a lot of that going around. 855-935-TALK is the number, 855-935-8255. I'm Don McDonald. That's Tom Cock. And on the phone, we have Terry. Terry, welcome to Talking Real Money.
Hello, Terry.
Thanks, Dan. Hello. Nice to speak to you.
Thank you.
You both advocate a two-pronged Vanguard approach. Do we use the traditional mutual fund, or do we go with ETFs? Like, would I use VT and BND for the stock and the bond fund, for example?
You know, I'm okay with either. Here's the thing: I'd have to go back and look at those particular funds, but mutual funds in general, in this particular environment, have fared better than the ETFs. Not everybody knows why. I mean, some of it, there's some belief because ETFs are traded during the day. There's some beliefs in the way they're constructed.
Don't always track.
Yeah, they don't
always
track the
exactly
indexes.
track the index. There are a few little quirks in ETFs that it keeps them from being my first choice. You know how they say 6 one way, half a dozen the other?
Right.
It's 50-50 chance. Well, with the difference between funds and ETFs for me is 7 one way, 5 the other.
That's about right.
You know, the ETFs are going to be fine if you have no other choice, or if you're in an account where they have usurious transaction fees for Vanguard funds. Like, for example, you had an account at like TD
Fidelity.
Ameritrade,
Right.
or Fidelity.
Yep.
You can get into VT and BND for very little, $6.95 transaction fees, whereas it might cost you $50 to get the Vanguard mutual funds. But if you're going straight to Vanguard, then I would go with the mutual funds, because I do know that the price you get is the price at the close of business every day. It's like clockwork.
Yeah, it's a good
there's
point.
There's no fiddling around with the price intraday.
Does that help?
It does. Could you repeat the tickers for the two mutual funds that you
The
recommend?
stock fund is VTWAX, Vanguard Total World Stock Index, VTWAX, and the bond fund is
We always forget this one, don't we? I do it every week. I
Vanguard
forget
Total-
it.
Spot, man.
yeah, no, that's fair enough. We should know this.
Just makes me look it up.
Because I just talked about it at a class just did last Wednesday, and it always comes up. So, but
I'm going to have to get flashcards for both of them.
we should have that. We should have that down. Don's going to give it to you right now. The Vanguard.
Except I have to keep
Okay,
jumping
all right.
through hoops.
I will do it myself here.
Total, no, I got you beat. Total bond. Total. Boy, my computer's slow.
VBMFX. Vanguard. B for bond. M for M. No, isn't that
no,
investor
that's
shares?
the old one.
Oh, that's the old one. That's right.
VBTLX. Huh.
Well, but if you tried to buy VBMFX, I think they would send you there. But
Yeah, VBTLX.
All right, thanks, guys.
VBTLX.
You bet.
All right. Thanks for the call,
get
Terry.
that
Take care.
tattooed on the back of my hand or something. Or something.
855. Yeah. What is that tattoo? Oh, that's a symbol for the
Total
Vanguard
Bond.
Total World Bond
Everybody got to
Index.
know that one.
Yeah, here. What we could do is just take little pictures of our arms and flash them at people.
Not a bad
with
idea.
Tattoos. 855. I forgot what I was going to say. The number. 855-935-TALK is our number. 855-935-8255. Give us a call. Jim, you're next. Welcome to Talking Real Money.
Hi, thanks for taking my call.
Costco
on Friday announced a $4 billion stock buyback, or authorized $4 billion stock buyback. Is that something that I should be concerned about or happy about?
Okay, if you're an investor in Costco,
which you should be, by the way,
buyback, yeah. If you are in a
Major
total market
company.
portfolio, you would be. A buyback is good for the share price because it reduces the shares outstanding, and if the demand stays the same, the stock price basically has to go up. But stock buybacks long term may not be good for companies because what it does is it takes capital that might have been used to grow the company, to actually make the company more valuable by building new stores in markets where they haven't penetrated yet, things that really can't help the bottom line. But today, companies are buying back. They're buying back their stock in record numbers. They're really a lot of what is supporting the stock market is company buybacks.
At the end of the day, honestly, Jim, I think it's a ho-hum. I mean, because so many firms have done it. I'm with Don. I don't think it's something that you should really be paying that much attention to.
As a matter of fact, I think about 99.8% of the financial news is not worth paying attention to.
Yeah, there is that. No, I mean, Costco's a great company. That they've done very well for the last, I don't know how long in public, 25 years, maybe longer. And you should own them in a diversified portfolio because they're a large U.S. company that should be part of any portfolio.
Thanks for the call, 855-935-TALK. That is our phone number, and that number works 24 hours a day, 7 days a week. So you can call in your questions anytime, and we'll answer them either here on the show or on the podcast.
Tom and Don are talking real money.
Tom and I believe in helping everybody become a better investor. That's why we offer lots of free knowledge at TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
Welcome back to the show. Shameless plug time because Don never lets me do it. Our classes, our lunch eds have been very popular, selling out. We got another one, I think, next week that's sold out. So
it's just because it's a great lunch.
Oh, okay,
That's
that must
all.
be
just
it.
because it's a great lunch.
We've got 2 more dates coming up. We got a Saturday morning because you wanted a brunch ed instead of a lunch ed. Right?
I thought it was
That's
a catchy
cute.
moniker.
And then that's Saturday, May 11th, and then a lunch ed on Wednesday, May 22nd. These are 1 hour. You get the lunch with it. It's a heck of a deal, and you can sign up right now, TalkingRealMoney.com. I will be talking about how to invest for retirement, how to get retirement income, and how to avoid those critical mistakes people seem to make as they get closer.
The reason I suggested a brunch ed was actually because a number of people wrote in saying, I can't get out on
a weekday.
weekdays.
Yeah, right.
Can you do the class on Saturday? So that I made you work on Saturday.
I'm good. I'm there every Saturday morning anyway.
I wanted to explain something before we go back to the phone.
Yeah.
On stock repurchases, stock buybacks, there are a couple of reasons why companies do them. One, this is going to make a lot of sense. If a company pays a dividend, they have to pay out that dividend, that $1 per share to every share out there. Mm-hmm. So if you buy back a bunch of shares, you don't have to pay that dividend anymore.
Yeah.
The other thing it does is it improves the balance sheet because there's a line item on the balance sheet that says earnings per share. You have 1 million shares, you make $1 million, you're making $1 per share. But if you buy back 500,000 of those shares, your earnings per share now have doubled. Your earnings per share doubled just by buying the stock.
And frankly, there are fewer and fewer companies that are going public that want to be public for a variety of reasons. There's the universe of those are getting smaller. So some people buy all the shares back eventually anyway. So some, not Costco.
So it historically has been very cyclical, privatizing, publicizing, et cetera. Let's go to the phones again at 855-935-TALK. And remember, you can call that number 24 hours a day, 7 days a week if you don't get through to the live show. Jim, welcome to Talking Real Money.
No, I think we're going to D first, actually.
Yeah, we went to Jim. I'm sorry. D, you're next. Welcome to Talking Real Money.
Hi, D. How are you?
Oh, hi. Thanks for taking my call.
You bet.
I've been listening today, and you suggest the two-prong approach, the total bond and the total world. And with my investments, I'm having a problem emotionally. I paid $4,000 for Starbucks stock, and that stock's now in my portfolio at $141,000. And I'm having trouble saying I should sell it, even though that's a huge amount of money if something went bad with Starbucks, like you're talking about
it's hard to kick somebody out the door who's treated you so well.
Yeah.
This is a relationship. You literally, people fall in love with stocks.
Indeed, they do.
And that's exactly what this is.
Well, then you have another partner,
it's your
by
emotions.
the way. Well, but you have another partner when you decide to sell it for that kind of gain. Called the government, because they're going to want a big hunk of it. I would never, if you walked in my office and said, I have all this money at Starbucks, what should I do? I would never say, well, just sell it tomorrow. That would be horrible because you'd have a huge tax consequence.
You have to do some tax planning.
Yeah, so you got to do the planning. But over time, I would be suggesting you sell down that position and move to something more diversified.
Yep.
And you mean take 50,000 or whatever the number and transfer it over to Vanguard?
Well, here's what you need to do first. There is actually an interim step. You need to probably sit down with an accountant, pay them a couple of bucks, let them look at your current tax situation, what the bracket is that you're in. You want to make sure that you don't sell too much, because there are now brackets for capital gains.
Yep.
And you want to make sure you don't get into the higher capital gains brackets. So consult with an accountant really quickly. Your accountant will be able to tell you how much of it you can sell without kicking the percentage you pay to the government up. So, yeah, I would gradually do it, whether it's $20,000 a year or $50,000 a year.
We don't know enough to know.
But neither of us, and most academics agree, you are not in a position where you should be in individual stocks. Buying individual stocks is a gamble that at times rewards you handsomely, as it did in your case, but at other times destroys you.
By the way, the longer you hold a stock, the riskier it is, right? Because the longer that company, there's a more opportunity for something to go wrong into the future, which most of the time is unforeseen. But great question, Dee.
855-935-TALK. Terry, you're on. Welcome to Talking Real Money.
Hello.
Hey.
Okay,
Hi,
so I have two questions. The first one is about long-term care. I have two options that have been provided to me. One is a long-term care insurance type policy. You pay a set amount of money per month. You can name a beneficiary, and if you do not use the long-term care insurance, your beneficiary can be paid out at the end. The other was a straight type of long-term care insurance policy. You pay a premium per month, and this particular payout will pay the interest goes up, or the amount of money goes up per month in the future. So
premium. So it's a straight premium versus a lump sum or a certain amount you're putting into the policy, correct?
Right.
Okay.
Correct. And I am at the age where I've been, just through research, you should have long-term care insurance before you turn 60. So I'm looking at needing to do this now.
It gets more expensive.
Yeah, right.
And I've qualified perfectly health-wise, and you never know what tomorrow brings.
I believe in I always go for the least complex approach, and that would be the straight long-term care insurance. I do not like these gimmicky insurance policies, these large premium policies with death benefits and investment riders, and they're go try to read the disclosure documents on those things. It'll make your eyes roll back.
If you could afford, here's the risk you take with the straight premium approach. Here's what's happened in the industry. 10 years ago, there were a lot more players because people could sell these things, and it looked like a good business to be in. What happened was they found out it was not. People lived longer. The expenses were higher, and so companies have quit writing the more traditional pay-as-you-go kind of plans. And here's the and for you, Terry, they also increase premiums dramatically. So you take some risk with that, and so that's something you need to balance out. I'm not opposed to long-term care because it's simply a transference of risk. You're saying, I'm giving it to the insurance company, you take that on. I'm with Don. I like simplicity. I'd rather just write the check every month and pay my premium.
However, it's a two-pronged approach to even determining whether you need it or not. And this is the most important thing you need to consider, Terry. What is the value of your portfolio going into retirement?
Terry?
You still there?
Alzheimer's.
I'm sorry?
Yes, I do need long-term care insurance. I have a family history of Alzheimer's in my family, and I don't have enough investments to take care of me if something happens.
Okay, so you need
Good. Then you need it.
coverage.
So
Yeah,
here's what
that's fine.
the other thing is when typically, at least in every instance, I've run numbers on these things. The straight long-term care comes out far less expensive because you got to figure a couple of things. That lump sum you put in there, you're losing the ability to make money on that money, and your benefits. I hope it's an apples to apples comparison of the benefits, but generally you're going to find you have larger benefits on the true long-term care policy that will last for a longer period. You're going to have better coverage, in other words. So look at your policies very carefully. All things being equal, I would lean toward the premium policy as opposed to the lump sum policy. Thanks for the call. Truly appreciate it. We wish you well in the future. And remember, you can call 855-935-TALK anytime, 24 hours a day, 7 days a week, and get answers to your questions on our weekday podcast.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor's a fiduciary at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And if you want to learn how simple it is to invest for the income you need in retirement, you must attend one of our classes. We've been doing classes for many, many years. We have our Retire Meet, but right now Tom's doing a series of lunch eds. The last two have sold out completely. There's another one coming up on May 11th, and then, that's our brunch ed in the morning on Saturday morning, and then May 22nd, another lunch ed. Go get your tickets right now because they will sell out at TalkingRealMoney.com. They're cheap, and you get a meal included. TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.